So Theatres Trust is the national advisory public body for theatres. This is a part of a seminar series that we're offering to try and help theatres understand, in this massive information that everybody's trying to process at the moment, some of the key issues and where we are with that. This is the second one in this current run. We've got one next week on managing organisations in financial distress. So let's kick off with today's session. Obviously, insurance, business interruption insurance, has been a key issue for organisations who have been forced to close during this shutdown, and there have been a number of challenging. There's been a key case challenging business interruption claims, just to see what is eligible and what isn't eligible for which claims would be successful. So I think, Andy, if you'd like to give us a quick overview to begin with, that'd be really helpful.
Yeah, sure. Thanks, Tom. Thanks everybody for attending today and taking the time out. I'm sure you're all very busy. Yeah, as Tom alluded to, I thought probably the best thing to do would be to just give initially a quick overview of the situation with the FCA's business interruption challenge to the wide-ranging declinature of business interruption claims following the lockdown in March. Initially, the intention of the FCA was to try and speed up the process of providing some clarity to insurers and to customers as to whether or not they should be actually paying claims that were submitted and then originally declined, on the back of the various wordings that insurers had in the business interruption field. That initially kicked off in July. There was a representative, I think they called it a representative sample of 8 insurers who agreed to be willing to be part of the court case. Those insurers were Arch, Agenta, Ecclesiastical, Hiscox, Amlin, QBE, RSA and Zurich, all to sort of varying degrees in terms of how many wordings they had and the differences that always seem to sort of pervade the wordings within the insurance market. The court case then came to its conclusion in September, and there were varying results depending on who the insurer was as to whether or not their wordings in the opinion of the court and obviously the FCA should respond. The ones who weren't found to be in a situation where their wordings should respond were Ecclesiastical, to a certain degree QBE, to a certain degree RSA and Zurich. And this was covering the areas of both the extensions for prevention of access to premises, to venues, and also the infectious disease extension that exists within most business interruption policies. Hiscox were found to be in a situation where the majority of their wordings should respond, as were Arch and Agenta, RSA on certain cases, Amlin on certain cases, and unsurprisingly, they decided that they'd like to appeal that decision. I think it's been fairly widely reported that the appeals were invited to be made at the beginning of October, and also the wish by the FCA to leapfrog the legal process in a sense, and move straight to the Supreme Court to again speed up any appeal process. I should also say that the FCA were also wanting to appeal some of the decisions that were made that weren't in their favour. So in a sense, it's trying to clarify for both sides. As well as the representative sample that were directly involved in the court case itself, most UK insurers also agreed that they would abide by the spirit of the final judgment in context of their own things. But at this time, at this stage, they've all indicated that they're going to hold off their decisions, unsurprisingly, until the appeal has taken place. The appeal is scheduled to start to be heard next Monday on the 16th and should last about 4 days, but the Supreme Court's judgment isn't actually expected until the new year, which obviously is very frustrating in terms of trying to move things forward quickly, because by the time we get to next year, we'll almost be a year into what was from the time from the original lockdown. In the meantime, the FCA's expectation is that any insurers who have claims that are declined but could be progressing, is that they should progress as much as they possibly can in terms of information gathering and decision making, so that when the final decision is made, and if that ultimately is in the FCA's favour and to the customer's benefit, then the payments should be made as speedily as possible, so as not to hold up any further sort of financial distress that would be causing. I think it's important also to note, in terms of the coverage, the cover in question is usually only something that forms a part of the business interruption insurance section. So it's only a fairly limited, in financial terms, extension that would be somewhere in the region of between 100 to 500,000 pounds, and probably would only be over a limited period of about 3 months from the date of the original interruption to the business. So where we are now, we're obviously well past those 3 months, and probably very much well past the sort of 100,000 to 500,000 pound financial damage that businesses have suffered. So that's, in a sense, where we are at the moment. I don't know if it's beneficial to people if I should go through other coverage issues at the moment that the insurance market might be facing and things to look out for. If people might find that beneficial, I can do that. Also, to sort of comment on the hardening insurance market, which is causing quite a few difficulties in terms of pricing going forward, and also the extent of cover that would be offered, and also the possibilities of there being any kind of COVID/pandemic cover going forward once things do actually settle down. I can do that now, or I can do that later on, depending on how the Q&A's.
Let's just stay on business interruption for now, just okay. to ask. So a few things about if people are looking to now renew. Obviously, they'd expect that wording would change so that they wouldn't be able to get the insurance. So they wouldn't be covered by that.
That's correct.
And then the other thing. So kind of drawing on what you were saying there, it sounds like this second lockdown is unlikely to have an effect of an additional claim because the limit is likely to have been reached. Is that what you're saying?
Quite possibly. I mean, it's difficult for me to comment on specifics of individual policies. Some may have aggregate limits, which mean that yes, by now the extension would have been exhausted. Some may have reinstated cover, which, if they haven't renewed their policy since the original lockdown, might mean, and I caveat that with a big, in capital letters, might mean that they could potentially have an additional claim, other than possibly looking at the fact that maybe it depends whether or not they were able to open in between the two lockdowns in a practical sense. So there are quite a few variables that might govern whether or not somebody could make a second claim, or indeed have a second claim. And that's one sort of caveat I suppose I'd have to make, is that I can't really comment on individuals' policies unless I already act for them.
Yeah, absolutely. Yeah, I think the purpose of today is very much about kind of a state of play, trying to understand those things. And yeah, if you've got specific queries, I think the guidance is very much go to your broker and ask.
In a sense,
about your specific policies. So you mentioned this claim is covering both prevention of access and infectious disease claims as two different kind of forms of cover. Is there are either of is it that a lot of the prevention of access claims have been successful, or is it the infectious disease claims that are successful, or is it a bit of a mix of both within the ruling?
It's a mix of both, because generally speaking, most policies would have both extensions in varying formats and with varying conditions as to how they might apply in terms of, say, for example, infectious diseases happening actually on the premises or within the vicinity or within a radius of a number of miles, and how that then is applied to the lockdown being applied. And the same for prevention of access. It very much depends on how that prevention is then perceived in context of the policy. And the test case is effectively using precedent from previous claims to try and ascertain how that can be applied in this situation.
Great. I'm not seeing any pressing questions coming through on business interruption, but if anybody has anything, then do drop something in the chat. If you'd like to kind of move on to talking about the broader insurance markets that you were alluding to earlier, I think that'd be a really useful bit of summary of the state of play more broadly.
Yeah, sure. Yeah. And I think as you alluded to, if we look at business interruption, firstly, it's likely that the first renewal, or not likely, it's definite that at first renewal, all policies would have an amended prevention of access and infectious disease wording. And it's definite that it's likely that exclusions will be placed on them to prevent there being any misunderstanding of the situation going forward. If COVID persists and there are further lockdowns, then there won't be any cover under the business interruption section of anyone's policies. And it's quite likely that as we move forward, if there are mutations and variations on a theme of COVID, that those will be covered off in terms of cover being excluded going forward. That's not to say that there might not be opportunities that insurers look to in the future to try and provide some kind of cover, but I think it's very much not for this foreseeable future, and certainly not within the next 12 months, the way things are. If you move on to things like employers and public liability, employers' liability, there shouldn't be a problem because legislation precludes the insurers from excluding that from the policy. So if you had situations where employees made allegations against you that you'd been negligent in dealing with the say the return to work, or even return, working during the pandemic, and that they haven't, the organisations haven't given them a safe place to work, and maybe somebody contracted COVID whilst they were working, and they wanted to allege it was as a result of the organisation's negligence, then that would be covered by policies. Public liability is slightly less straightforward in that there is a move by some insurers to exclude all communicable disease cover from public liability. Some will just be trying to exclude COVID, and some will be including the cover, which is quite a positive thing in a sense. And we, speaking from personal experience, we're only obviously working with people that will provide the cover, because effectively it's untenable for a venue to operate, and indeed a producer to operate without having communicable disease cover under their public liability section, because obviously it would be important if there's an audience member or audience members that were alleging that you were negligent in providing them with a safe place to visit, and that somebody had become ill as a result. Theoretically, there could be many claims that could arise from that going forward. But I'll not try to dwell on the negative too much in that sense. So the headline is that cover is available at the moment, but you've got to bear in mind that it might not continue, and you should always check and make sure that cover has been included when your policies come for renewal, to ensure that you're as covered as much as possible from a legal liability perspective. In terms of cancellation cover, which is a slightly different aspect to business interruption, and is probably more relevant to producers, but venues do buy it. At the moment, there is no cover available, surprisingly. for COVID, and that's unlikely to change for the foreseeable future. I'm sure that most people are aware that the industry is trying to work with the DCMS and lobbying them to provide some kind of similar scheme to that the film and TV industry have. But there doesn't seem at the moment to be a lot of will on the part of the DCMS to provide sort of financial assistance or some kind of government indemnity for it. Basically, I think because the risk profile is quite different to the film and TV industry, and they can't quite get their head around the sort of financial model of it at the moment. Obviously, the UK Theatre Association and SALT are lobbying members to try and put something together that the DCMS will understand. There's a possibility that in time that there will be cover available for pandemics in the future, but it's not likely to be sometime, is the headline on that. Travel insurance is not too bad. There's limited cancellation cover for trips that is becoming more widely available within the insurance industry. Generally speaking, it's limited amounts and aggregated over a year, but the cover is there. And things like medical and repatriation expenses are generally covered within the policies as they stand anyway, as long as obviously you're not travelling against FCO advice and guidance. The most problematic area, I think, at the moment, other than the obvious BI and business interruption and cancellation areas, is the charity protection come management liability come directors and officers cover, which although cover is still being provided, it's being very much done on a restricted and increased cost basis. Continuing the theory, the subjects of good news, typically you're going to see large premium increases, probably anywhere from 50 up to 100% in terms of those particular policies. Cover will possibly be removed, or limits will be reduced, or excesses will be increased. Effectively the economic effects of the pandemic and what that's created means that that particular sort of part of the insurance market has become very nervous about the potential for a huge amount of claims to come in for things like employment practice liability, which is effectively covering unfair dismissal or constructive dismissal or redundancy processes that may not have followed correct guidelines and that kind of thing. And where staff are obviously adversely affected. We do live in a relatively litigious society, and the feeling is that this might produce a mountain of new claims that come under those policies. We haven't seen that yet, but the feeling is that might well be the case in the coming months. So that area of the insurance market is becoming trickier and trickier. In a sense, the market itself is very much hardening, and rates are increasing, covers are reducing. But it would actually be wrong to say that it's all down to COVID. It's just basically that what COVID has done is help create what you might see as a perfect storm for insurers that's been brewing for the last 3 or 4 years. The main reasons being, yes, COVID is definitely a large factor. Losses in the UK in the insurance market are expected to be somewhere in the region of about £3.25 billion, and then many hundreds of billions of pounds across the world. That will mean effectively that the reinsurance costs and the reinsurance market that effectively underpins the insurance industry around the world will probably have to increase their rates. So anywhere from 40% upwards, which will then mean that increased cost is passed on to the customer by the insurers because they can't avoid it, and they wouldn't have any choice but to do that. Property insurance rates seem to have been woefully low, sort of for the past 3 or 4 years up to 2020, and then people forget, I guess, that unless you've been directly affected, for which I apologise for brushing over it in a sense, but the January-February floods were going to cause a massive issue in that sense. Again, the cost to the insurance industry was about 500 million, or will be about 500 million pounds. And then from a scientific perspective, the way that rates are put together tend to be on a sort of an actuarial sense, and they look at the probability of large events that would affect the insurance industry happening, and there were 3 what they would term one in 100-year events in the last 10 years. So all that has been building and building in terms of taking cash, if you like, out of the insurers' pockets. And then basically the final thing is the changes to what they call the Ogden tables, which again is an actuarial thing, which covers the level of employers' liability payments that are given to injured employees that are successful in making claims. And it's envisaged that the changes to the tables will mean that future payments that have to be made by insurers when cases are lost or where they have to admit liability will probably increase by 100 to 120% on what they were. So all in all, it's a pretty grim picture from within the industry, and looking outwards, obviously, it's just as grim.
So it's prepare for your premiums to rise is the message.
It was a long way around of saying that, in a sense, but just trying to give some context to it more than anything else.
Yeah.
So yeah, here endeth the
what a useful trove of information that was.
Good news.
So a few things to pick up on there. So yeah, you mentioned that SALT UK Theatre are campaigning for for cancellation insurance. There's a survey out now, actually, which UK Theatre members should be responding to talk about their what they might be able to mount in the event of having cancellation insurance in place in various different forms, which if you're a UK Theatre member, I'd encourage you to respond to. We're working closely with them and the other theatre sector bodies and discussing these things on an ongoing basis. And yeah, it's probably a key one for those producing theatres amongst us. So yeah, a really important one. We've had a question in about the impact of theatres being unoccupied during this lockdown period, and how they're concerned that the level of cover could be reduced as a result of them being unoccupied and not having a regular programme of shows in, for example, and was wondering whether that's kind of a widespread issue that's being experienced.
It shouldn't be too bad. It shouldn't be too much of an issue at the moment, because to be fair to insurers, they have responded to that in a flexible sense to say, look, we appreciate that you can't run normal operations or have the building occupied in the normal way that you would expect over the last few months. Generally speaking, there is an occupancy condition within most policies that says if you're unoccupied or not able to trade to normal levels or have occupancy at normal levels, after 45 to 60 days on average, then the insurers will reduce the cover. So they'll take out things like storm or flood or burst pipes, that kind of thing. But certainly with the insurers that we deal with, we've agreed with all of them that they will continue to maintain full cover until the situation resolves itself. That might change, but that's what we have agreed with our carriers at the moment, so as not to obviously add insult to injury in terms of if then there is a claim that happens where there's been damage at a venue, that you then not faced with additional financial hardship because the cover's been withdrawn. So in essence, it could be a problem, and I would encourage obviously anybody who is unsure to check with their insurers or their brokers, but certainly from our perspective, it's not a problem. And
are you? And I mean, this is a thing that kind of is no doubt evolving and will come out of the woodwork over time. But are you aware of any claims that people might be making under public liability? Are there cases where members of the public have been trying to make claims against organisations as a result of coronavirus?
Not yet.
Yeah.
I'm pleased to say, not yet. Although difficult, as most of the public can't even get in there, isn't it? So.
Yeah, no, absolutely. But
not at the moment.
Great. Just to open the floor, see if there's any other questions that have come out from things. Somebody's pointed out in the chat that I neglected to introduce you properly there, Andy. So very sorry, Andy Rudge from Tysers. And I wanted to thank Andy for coming in and talking to us today, because obviously a very complex thing for us to all try and get our heads around, which and a moving feast, as we find with the Supreme Court decision to come. But certainly it's important for us to try and stay on top of where we are in the current state of play. Any other questions from the floor just before we wrap up and thank Andy for joining us? I don't see anything. Do you have anything, Tash? No, great. Well, so thank you very much, everybody, for coming along. This session, I certainly will be watching back to go through all of the different areas of other cover. There was absolutely a very valuable set of information about different sorts of insurance. So the recording will be available in the next few days on our site. So as I say, Theatres Trust have got a number of other upcoming seminars which are free to attend. The next one is Managing Financial Distress, which is the same time next week, 1 o'clock on Wednesday, if anybody would like to attend that, with lawyers from Bates Wells in attendance. I'd like to thank the Garfield Weston Foundation, who have provided us with some funding to deliver these sorts of seminars, and thank you all very much for attending. If you have any specific advice queries, then by all means contact me. I'm Tom Stickland, tom.stickland@theatrestrust.org.uk. Very happy to answer any specific advice queries that you may have in the operation of your theatre. Thanks everyone for coming.